Introduction to behavioral assumptions in banking, setting the foundation. In the world of banking, understanding customer behavior is key to success. Behavioral assumptions enable banks to better serve their clients. Let's delve into what these assumptions are and how they shape the industry. What are behavioral assumptions? Behavioral assumptions refer to the beliefs and expectations about how individuals will act in specific situations. In banking, these assumptions help in predicting how customers will react to services, products, and policies. For example, a bank may assume that a customer who frequently travels abroad will prefer a credit card with no foreign transaction fees. Understanding these assumptions allows banks to tailor products and enhance customer experience. The role of behavioral finance. Behavioral finance plays a significant role in understanding customer decisions. Traditional finance theories assume that individuals are rational and make decisions solely based on logic. However, behavioral finance recognizes that emotions and cognitive biases also influence financial decision-making. For instance, the fear of missing out may lead a customer to invest in a trend without fully understanding the risks involved. By acknowledging these factors, banks can craft messages and offers that resonate more effectively with their clients. Common behavioral assumptions in banking. Risk aversion. One of the most common behavioral assumptions in banking is risk aversion. Customers often prefer safer investment options with lower returns rather than riskier assets that could yield higher profits. This means that banks should focus on promoting secure products, like savings accounts and government bonds, to attract conservative investors. Present bias. Present bias refers to the tendency of individuals to prioritize immediate rewards over future gains. For example, a customer may be more inclined to spend their money now rather than save for retirement. Banks can address this bias by offering incentives for saving, such as higher interest rates for long-term deposits or automatic savings plans that make saving easier. Social influence. Humans are inherently social beings, and this affects their financial decisions. Many customers often look to friends, family, or social networks for advice on banking products. By tapping into this social influence, banks can use testimonials and referrals to encourage new customers to try their services. For example, promotional campaigns can feature satisfied customers sharing their positive experiences, enhancing credibility and attracting new clients. Implications for banking strategies. Understanding these behavioral assumptions allows banks to develop tailored strategies. Here are a few ways banks can apply this knowledge. Personalized marketing. With a grasp of behavioral assumptions, banks can craft personalized marketing strategies that speak directly to their customers' needs. For instance, if a bank understands that a segment of its clientele is predominantly risk-averse, targeted advertisements for high-yield savings accounts could lead to increased engagement. Education and transparency. Educating customers about products and services fosters trust and helps mitigate biases. By providing clear information and guidance, banks can empower clients to make informed decisions. For instance, webinars, workshops, or informative content on their website can enhance customer understanding and engagement. Improving customer experience. Behavioral insights also guide banks in refining their services. For example, by recognizing the importance of social influence, banks can create referral programs that reward customers for bringing in new clients. Additionally, user-friendly mobile apps that facilitate easy access to funds or savings could cater to present bias, encouraging better financial habits. Conclusion. Behavioral assumptions are a crucial element in the banking industry. By integrating insights from behavioral finance and understanding customer psychology, banks can create more effective strategies to engage their clientele. By acknowledging risk aversion, present bias, and social influence, financial institutions can enhance customer satisfaction, loyalty, and ultimately, profitability. Understanding these foundations sets the stage for successful banking in the modern era. Understanding customer behavior, the impact on financial modeling. In the world of finance, understanding customer behavior is paramount. It's not just about numbers and profits, it's about analyzing what drives your customers, how they make decisions, and how these factors influence financial forecasting. Today, we'll explore how customer behavior impacts financial modeling and helps businesses make informed decisions. Why customer behavior matters. Customer behavior refers to the actions and decision-making processes of individuals when purchasing goods or services. This includes their buying habits, preferences, motivations, and the factors that drive their decisions. In financial modeling, incorporating customer behavior is crucial because it improves accuracy. Traditional financial models often focus solely on historical financial data. Informs budgeting. Knowing how customers behave helps in creating realistic budgets. Enhances risk analysis. By analyzing trends in customer behavior, financial models can better account for risks associated with market fluctuations. Key factors influencing customer behavior. To effectively integrate customer behavior into financial models, it's important to identify the key factors that influence these decisions. Emotional triggers. Emotions play a significant role in purchasing decisions. Understanding what emotional triggers lead customers to buy can greatly enhance financial modeling. For instance, if a company knows that customers feel happiness associated with their product, this can influence projected sales during marketing campaigns that evoke similar emotions. Social influences. People are influenced by their peers, family, and social trends. A financial model that takes social behavior into account can predict sales spikes during popular trends or social media influences. Businesses can adjust their forecasts based on these social dynamics. Economic conditions. The state of the economy directly impacts consumer spending. Financial models that integrate customer behavior must account for economic downturns or booms. Analyzing customer reactions to different economic conditions can help predict long-term sales trends. Techniques for integrating customer behavior into financial models. Once you understand the importance of customer behavior, the next step is to incorporate it into your financial models. Here are some proven techniques. Data analytics. Utilizing data analytics to assess customer purchasing patterns is crucial. By utilizing tools like Google Analytics, CRM systems, and consumer surveys, businesses can gather valuable insights into what drives customer behavior. Integrating this data into financial models can lead to more accurate sales projections. A/B testing. A/B testing involves comparing two versions of a product or marketing campaign to see which performs better. The results can offer insights into what drives customer decisions, which can then be reflected in financial forecasts. Segmentation analysis. Dividing customers into segments based on demographics, behavior, or preferences allows businesses to tailor their offerings effectively. This analysis can then inform financial models on how to allocate resources and forecast different revenue streams. Conclusion. Understanding customer behavior is essential for creating robust financial models. By integrating insights into purchasing habits, emotional triggers, and social influences, companies can enhance their forecasting accuracy and make informed decisions that drive growth. In an ever-evolving market, staying ahead means adapting to what customers want and how they behave. Financial modeling that takes these elements into account provides a clearer picture of potential business success. Adapting to customer behavior changes isn't just a strategy, it's a necessity for any business looking to thrive in today's competitive landscape. Prepayment modeling, assumptions and their significance. In the world of finance, particularly in mortgage-backed securities and loans, prepayment modeling plays a critical role. Understanding prepayment behavior helps lenders, investors, and analysts make informed decisions. Today, we'll dive into the assumptions behind prepayment modeling and why they are significant. What is prepayment modeling? Prepayment modeling examines the frequency at which borrowers pay off their loans before the maturity date. Prepayments can occur for various reasons, such as refinancing, selling the property, or simply having excess cash. This modeling helps predict cash flows and assess the risk associated with different financial instruments. The key assumptions. Interest rate sensitivity. One of the foremost assumptions in prepayment modeling is interest rate sensitivity. Borrowers are more likely to refinance their loans when interest rates drop. Conversely, when rates rise, prepayments decline. By understanding this relationship, analysts can assess the market's potential movements and their impact on prepayment rates. Economic factors. Economic conditions also significantly influence prepayment behavior. Factors such as unemployment rates, housing market trends, and consumer confidence play a role. For instance, in a strong economy, borrowers may feel more secure in refinancing, while in a downturn, they may choose to hold onto their current loans. Modeling must take these factors into account for accurate predictions. Borrower characteristics. Prepayment modeling often considers borrower demographics, such as age, income level, and credit score. Younger borrowers may be more likely to move or refinance, while older ones might stay in their homes longer. By segmenting borrowers, analysts can create more tailored predictions regarding prepayment behavior. Loan characteristics. The characteristics of the loans themselves, such as the type, fixed rate versus adjustable rate, size, and terms, significantly affect prepayment patterns. For instance, adjustable rate mortgages often see higher prepayment rates during periods of low interest rates, as borrowers refinance to lock in better rates. Seasonality. Seasonality can influence prepayment activity. For example, spring and summer often see higher home sales, leading to increased prepayments. Understanding these seasonal patterns is essential for creating accurate forecasting models. Why are these assumptions significant? Risk assessment. Understanding the assumptions behind prepayment modeling is crucial for risk assessment. Investors need to know how sensitive their portfolios are to prepayment risk. By accurately modeling prepayments, they can make better investment decisions and manage their exposure more effectively. Cash flow predictions. Loan servicers and investors rely on accurate prepayment modeling to predict cash flows. If prepayment rates are miscalculated, it could lead to significant mismatches between expected and actual returns. This can have far-reaching consequences for financial planning and strategy. Valuation of securities. For mortgage-backed securities, accurate prepayment assumptions are vital for valuation. Securities with embedded prepayment options need precise modeling to assess their fair value. Misjudging prepayment rates can lead to underpricing or overpricing of these securities in the market. Regulatory compliance. In the wake of the 2008 financial crisis, regulators have emphasized the importance of robust risk management practices. Accurate prepayment modeling is part of this framework. Institutions must ensure they maintain models that accurately capture borrower behavior and comply with regulatory standards. Conclusion. Prepayment modeling is an essential tool in the financial industry, enabling participants to make informed decisions based on borrower behavior. The assumptions behind these models, interest rate sensitivity, economic factors, borrower and loan characteristics, seasonality, are crucial in understanding the nuances of prepayment risk. As markets evolve, continuous refinement of these models will help stakeholders navigate the complexities of prepayments effectively.
Deposit behavior. Analyzing the drivers behind customer decisions. Understanding deposit behavior is essential for businesses in the banking and finance sectors. Today, we'll delve into the key drivers influencing customer deposit decisions. What is deposit behavior? Deposit behavior refers to how customers choose to deposit money, whether it's through savings accounts, current accounts, or fixed deposits. It's vital to understand what drives these choices, as they can significantly impact a financial institution's stability and growth. Psychological factors. One of the main drivers behind deposit behavior is psychological factors. Trust is fundamental. Customers need to feel their money is safe and secure. Research shows that customer confidence in a bank's stability can influence their deposit amounts significantly. Another psychological driver is the emotional connection customers have with a brand. Financial decisions are often influenced by personal experiences, family recommendations, or a brand's reputation. A bank that promotes transparency and customer-centric policies tends to foster a positive emotional response. Economic factors. Economic conditions also play a crucial role. During periods of economic uncertainty, individuals tend to save more and opt for safer deposit accounts. Conversely, in a thriving economy, consumers might be more inclined to invest in stocks or businesses rather than keeping large sums in savings accounts. Interest rates are another key economic driver. Higher interest rates usually attract customers to deposit with banks, as they want to make the most of their money. On the flip side, low interest rates might lead customers to look for alternative investment opportunities. Technological influence. In today's digital age, technology significantly influences deposit behavior. The rise of online banking has made it effortless for customers to manage their accounts and make deposits anytime, anywhere. User-friendly apps and websites encourage more deposits, as customers appreciate convenience. Moreover, advancements like fintech solutions and mobile payment systems have transformed how customers view deposits. Many younger customers prefer digital wallets and peer-to-peer payment apps over traditional banking methods. Banks need to adapt to these changing preferences to not only retain existing customers, but also attract younger demographics. Social influences. Social factors also contribute to deposit behavior. Social proof, seeing others engage with a bank or brand, can influence potential depositors. A strong online presence, positive reviews, and active engagement on social media can create a sense of community, making customers feel more connected and more likely to deposit. Additionally, the rise of influencer marketing cannot be overlooked. When financial gurus or influencers endorse a specific bank or saving product, their followers may be driven to invest or deposit accordingly, relying on perceived credibility. Behavioral trends. Behavioral economics also highlights the importance of nudge theory in understanding customer decisions. Subtle prompts, like reminders to save or highlighting limited-time offers, can significantly impact deposit behaviors. Customers often need a little push to make financial decisions, such as starting a savings account or increasing deposits. Moreover, personalization plays a vital role. Tailored offers based on a customer's past behavior and preferences can entice individuals to open more accounts or increase their deposit amounts. The more a bank understands and responds to its customers' needs, the better it can drive deposit behaviors. Conclusion. In summary, deposit behavior is influenced by a complex interplay of psychological, economic, technological, social, and behavioral factors. Understanding these drivers enables financial institutions to tailor their offerings and strategies effectively, ensuring they not only meet customer needs, but also foster loyalty. By focusing on building trust, adapting to economic conditions, leveraging technology, and utilizing social influences, banks can position themselves favorably to encourage positive deposit behaviors. Hence, analyzing the drivers behind customer decisions is essential for any bank aiming to thrive in today's competitive landscape. Loan repayment behavior, key assumptions in credit risk management. Understanding loan repayment behavior is crucial for effective credit risk management. In this video, we will explore the key assumptions that underpin this complex area. Introduction to credit risk management. Credit risk management involves assessing the risk of a borrower defaulting on a loan. Lenders need to predict repayment behaviors to make informed lending decisions. Assumptions in this area can significantly impact a financial institution's strategy and profitability. Assumption 1. Borrower creditworthiness. The first assumption centers around borrower creditworthiness. Traditionally, lenders assess credit scores, income levels, and employment stability. A strong credit history often correlates with timely repayments. However, while credit scores are a valuable tool, they should be used alongside other qualitative factors for a holistic view. Assumption 2. Economic environment. The second assumption relates to the macroeconomic environment. Economic factors, including interest rates, unemployment levels, and GDP growth, play a vital role in repayment behavior. For instance, during economic downturns, borrowers face financial stress, leading to increased defaults. Therefore, lenders should constantly analyze economic trends and adjust their models accordingly. Assumption 3. Behavioral factors. The third assumption focuses on behavioral economics. Borrowers are not always rational. Emotional and psychological factors can influence repayment. For example, financial literacy impacts how individuals manage debt. Assumptions about borrower behavior must account for these emotional drivers, as they can lead to unexpected defaults despite financial indicators suggesting otherwise. Assumption 4. Loan structure. Next, consider the structure of the loan itself. Fixed versus variable interest rates, payment terms, and loan type can significantly impact repayment behavior. Complex loan structures might confuse borrowers, leading to missed payments. Simplicity in loan terms can improve borrower understanding and, consequently, repayment rates. Assumption 5. Borrower communication. Another crucial assumption is the role of communication. Regular communication between lenders and borrowers can help manage expectations. Effective engagement might involve reminders of due dates or financial wellness resources. This relationship can demystify the loan process and encourage timely repayments. Assumption 6. Predictive modeling. The sixth assumption involves the use of predictive modeling. Advanced analytics and machine learning can enhance credit risk assessments. These tools can analyze large datasets to identify patterns and improve loan performance predictions. However, models are only as good as the data fed into them, making it essential to collect accurate borrower information continuously. Assumption 7. Regulatory environment. The regulatory environment is another key assumption. Changes in laws can affect credit risk management practices and borrower behaviors. Lenders must stay updated on regulatory changes that impact their operations and borrower assessment criteria. Assumption 8. Default recovery rates. Finally, understanding default recovery rates is vital. When a borrower defaults, lenders rarely recover the full amount loaned. This affects how lenders view potential risks. Assumptions about recovery rates can influence both lending strategies and loan pricing. Accurate forecasting in this area prevents losses and informs risk appetite. Conclusion. In conclusion, loan repayment behavior is influenced by a variety of key assumptions within credit risk management. By critically examining factors like borrower creditworthiness, economic trends, behavioral influences, loan structure, communication, predictive modeling, the regulatory environment, and default recovery rates, lenders can create a robust framework for managing credit risk effectively. Understanding and adapting to these assumptions can significantly improve a lender's forecasting accuracy and overall risk management strategies. Modeling non-maturity deposits, behavioral approaches and challenges. In the financial industry, non-maturity deposits such as checking and savings accounts are crucial for liquidity management. However, their modeling presents unique challenges due to their unpredictable behavior. In this video, we'll explore the behavioral approaches to modeling non-maturity deposits and the challenges that arise. Understanding non-maturity deposits. Non-maturity deposits differ from fixed-term deposits. Customers can withdraw and deposit funds at any time, which leads to significant variability in balances. Modeling these deposits accurately is essential for banks to manage liquidity risk and optimize their balance sheets. Behavioral approaches. Rate sensitivity. One of the primary behavioral approaches involves analyzing how interest rate changes affect deposit levels. Research indicates that customers may be sensitive to rate changes, but their reactions can vary. Some may choose to switch banks for better rates, while others might remain loyal regardless of rate fluctuations. The challenge lies in quantifying this sensitivity effectively. Historical data analysis helps in identifying patterns, but external factors, like market conditions and economic events, can complicate predictions. Tenor modeling. Another approach is to model the tenor, or the duration, that customers typically keep their funds in non-maturity accounts. Using mixed approaches like historical data, regression analysis, and machine learning can provide insights into customer behavior. Segmenting the deposit base into different categories can also help tailor models more accurately, reflecting differences in behavior among customers. However, segmentation increases complexity and requires ongoing adjustment. Customer behavioral patterns. Understanding customer behavior is key. Behavioral finance principles suggest that emotional factors can influence decision-making. Deposits may be influenced by life events or external economic factors, like a financial crisis, which could lead customers to withdraw large sums unexpectedly. Capturing these behavioral nuances requires comprehensive data collection, something that poses logistical challenges, as banks must balance privacy concerns with the need for data. Challenges in modeling non-maturity deposits. Data quality and availability. The first challenge is obtaining high-quality, reliable data. In many cases, banks may not have sufficient historical data to model behaviors accurately. Even with data, poor data quality or inconsistencies can skew results, leading to inaccurate predictions. Regulatory changes. Regulatory environments are also continuously evolving. New regulations can alter customer behaviors, rendering previous models ineffective. Banks must stay agile to adapt to these changes and incorporate them into their modeling frameworks. Advanced modeling techniques. Implementing advanced modeling techniques, like machine learning, can be a double-edged sword. While these techniques bring the promise of improved accuracy, they also require significant investment in technology and expertise. Further, complexity in these models can make them less interpretable for decision-makers who need straightforward insights. Macroeconomic factors. Macroeconomic factors play a significant role in deposit behaviors. Economic downturns and uncertainty can lead to unpredictable deposit movements. Integrating macroeconomic models with behavioral approaches is essential, but remains a challenge, as it requires a deep understanding of how different variables interact over time. Conclusion. Modeling non-maturity deposits is a multifaceted challenge that banks must navigate to ensure effective liquidity management. By employing diverse behavioral approaches and addressing the inherent challenges like data quality, regulatory changes, and advanced modeling techniques, banks can gain better insights into customer behaviors, enhancing their liquidity strategies and overall financial stability.
Behavioral assumptions in stress testing, preparing for economic uncertainty. In today's ever-changing economic landscape, understanding behavioral assumptions in stress testing has never been more critical. As organizations prepare for potential turmoil, let's unravel the connection between behavioral psychology and effective stress testing. What is stress testing? Stress testing assesses how financial institutions can handle extreme conditions, simulating worst-case scenarios to identify vulnerabilities. The goal is to ensure organizations have robust risk management processes in place to withstand financial shocks. Why behavioral assumptions matter? Behavioral assumptions are rooted in the idea that human behavior often deviates from rationality. Economic models frequently assume that individuals make decisions based solely on data. However, emotional and psychological factors play a crucial role. Understanding these behaviors during stress scenarios can help predict how markets and individuals may react in times of economic distress. Example: the 2008 financial crisis. The 2008 financial crisis is a classic example of behavioral assumptions failing in stress tests. Many institutions underestimated the impact of panic selling, overconfidence in asset prices, and herd behavior. As people rushed to withdraw funds or liquidate assets, the results were catastrophic, emphasizing the need to incorporate behavioral psychology into risk assessments. Key behavioral elements to consider. Loss aversion. People tend to fear losses more than they value gains. In a stress scenario, this can lead to overly defensive actions, such as hastily selling investments at a loss. Stress tests should model these responses to evaluate how swiftly an organization might react to perceived losses. Herd behavior. During uncertainty, people are likely to follow the crowd, which can exacerbate market volatility. Stress tests must account for this tendency by simulating scenarios where panic spreads, leading to rapid sell-offs or changes in consumer behavior. Overconfidence bias. Many individuals overestimate their knowledge and predictive abilities. In stress tests, this assumption can lead to a false sense of security, where institutions fail to prepare for worst-case scenarios. Understanding this bias can refine stress testing strategies and improve organizational readiness. Emotional responses. Fear, anxiety, and panic can significantly influence decision-making during crises. Stress tests should consider how emotional reactions might affect operational stability, lending practices, and consumer behavior. Integrating behavioral assumptions into stress testing. Incorporating these behavioral factors requires a multidisciplinary approach. Collaboration between risk management, behavioral finance experts, and data scientists is essential to refine stress testing models. Here are some steps to integrate behavioral assumptions effectively. Develop scenarios. Create realistic economic scenarios based on historical precedents and behavioral research. This will lead to more accurate modeling of potential responses by stakeholders during stress situations. Use advanced analytics. Employ advanced analytics and simulations to model behavioral responses. Machine learning algorithms can analyze vast datasets and identify patterns that might not be visible through traditional analysis, inherently capturing psychological factors. Continuous review. Behavioral attitudes change over time, especially with evolving market conditions. Regularly reviewing and updating stress testing models to incorporate the latest behavioral research will enhance predictive accuracy. Conclusion. As uncertainty remains a part of the economic landscape, integrating behavioral assumptions into stress testing practices is critical for organizations looking to bolster their risk management frameworks. By acknowledging how human behavior influences market dynamics, institutions can better prepare to weather economic storms ahead. Understanding the psychology behind decision-making can greatly improve the resilience of financial systems. This proactive approach goes beyond traditional financial metrics to encompass the human elements that shape market behavior. By implementing these insights, organizations can safeguard their operations and foster a more sustainable approach to handling economic uncertainty. The role of historical data in behavioral modeling, best practices. In the realm of data science and analytics, behavioral modeling plays a crucial role in understanding how individuals or groups behave in various contexts. One cornerstone of effective behavioral modeling is the use of historical data. This video explores the best practices for leveraging historical data to enhance your models. Understanding historical data. Historical data refers to datasets collected over a significant period. This data provides insights into past behaviors, trends, and patterns that can help predict future actions. By analyzing this data, we can identify correlations and make informed decisions about current and future strategies. Why historical data matters. The significance of historical data lies in its ability to reveal patterns that might not be immediately obvious. For instance, sales data from previous years can indicate seasonal trends, helping businesses prepare for peak periods. Additionally, understanding past user interactions can help improve customer segmentation and targeting in marketing campaigns. Best practice number 1. Ensure data quality. The foundation of any robust behavioral model is high-quality data. It's essential to assess the accuracy, completeness, and consistency of your historical datasets. Cleanse your data by removing duplicates, correcting errors, and filling in missing values. Remember, poor quality data leads to unreliable models. Best practice number 2. Contextual relevance. When selecting historical data, it's important to use data that is contextually relevant to your model. Consider the time frame of the data and whether it reflects the conditions that apply today. Economic conditions, consumer preferences, and technology can shift significantly. Thus, using outdated data may lead to misleading conclusions. Best practice number 3. Time series analysis. For behavioral modeling, time series analysis is a powerful technique. It helps in identifying trends, cycles, and seasonal variations within historical data. By applying time series analysis, you can forecast future behaviors based on historical patterns, adjusting models as new data becomes available. Best practice number 4. Incorporate different data sources. Don't rely solely on one type of data. Integrating multiple data sources enriches your behavioral model. Mix structured data, such as transaction records, with unstructured data, like customer reviews and social media interactions. This comprehensive approach provides a more holistic view of behavior and leads to better predictions. Best practice number 5. Continuous updating. The role of historical data doesn't end after the initial analysis. Implement a system for continuous updating and re-evaluation of your models. Regularly incorporate new data to keep your models relevant. As trends shift, staying updated allows for agile responses to new behavior patterns. Best practice number 6. Validate your models. Before fully deploying your behavioral model, validate it using a test dataset. This process ensures that the model can generalize well to new, unseen data. Use techniques like cross-validation to assess model performance and fine-tune parameters to improve accuracy. Case study: successful implementation. Let's look at a case study. A retail company utilized historical sales data alongside customer behavior data to develop a predictive model for inventory management. By filtering out irrelevant or outdated data, focusing on seasonal patterns, and continuously updating their datasets, they were able to reduce stockouts by 30% and improve customer satisfaction. Conclusion: incorporating historical data into behavioral modeling is crucial for making informed predictions and decisions. By following best practices such as ensuring data quality, contextual relevance, and continuous updating, you can enhance the accuracy and reliability of your models. Remember, the insights gathered from historical data are not just about the past, they provide a roadmap for future actions. Embrace the power of historical data in your behavioral modeling efforts and watch your predictive capabilities soar. Advanced techniques in behavioral assumptions, balancing accuracy and realism. In the realm of psychological research and behavioral analysis, the representation of human behavior is crucial. Today, we delve into advanced techniques in behavioral assumptions, focusing on balancing accuracy and realism. Understanding behavioral assumptions. Behavioral assumptions serve as the foundation for predicting how individuals may act in various situations. These assumptions are often derived from previous studies, theoretical frameworks, and empirical evidence. Nonetheless, the challenge lies in ensuring that these assumptions accurately reflect real-world behavior without oversimplifying complex human actions. The importance of context. One of the first techniques to enhance the accuracy and realism of behavioral assumptions is recognizing the context. Human behavior is highly situational. Factors such as environment, social norms, and individual differences can greatly influence actions. By integrating context into our assumptions, we can create more sophisticated models that account for variability in behavior. Techniques for contextual analysis. Situational variables. Develop frameworks that identify and analyze situational variables relevant to the behavior being studied. This could include environmental factors, stresses, or cultural influences. Quantifying these variables can lead to more nuanced understanding and predictions. Behavioral segmentation. Segmenting your audience based on specific characteristics allows for tailored behavioral assumptions. This can help identify how different groups might respond in similar situations. For instance, age, cultural background, and socioeconomic status can all play pivotal roles. Utilizing qualitative and quantitative data. Another advanced technique involves the combination of qualitative and quantitative data to strengthen assumptions. Quantitative data analysis. Quantitative methods provide numerical data that can reveal trends and patterns in behavior. Surveys and experiments can supply data that, when analyzed statistically, highlight correlations and causal relationships. Qualitative insights. On the other hand, qualitative research offers rich descriptive data, providing insights into the motivations and thoughts behind behaviors. Techniques such as interviews, focus groups, and case studies can uncover the why behind the numbers, allowing researchers to construct a more complete picture. Incorporating complexity through models. To achieve a balance between accuracy and realism, embracing complexity in behavioral models is essential. Dynamic modeling. Dynamic models allow researchers to visualize how behaviors evolve over time. By adjusting parameters, these models can simulate various scenarios, reflecting changes in context and individual circumstances. Agent-based modeling. Agent-based modeling takes this a step further by simulating individual agents that make choices based on a set of rules. This technique allows researchers to study emergent behaviors in large populations, making predictions more robust. Collaboration with multidisciplinary teams. Collaboration with experts from different fields can enhance the depth of behavioral assumptions. Engaging with psychologists, sociologists, statisticians, and data scientists can provide diverse perspectives and methodologies. This interdisciplinary approach can enrich the analysis and increase the accuracy of assumptions. Ethical considerations. As we delve deeper into behavioral assumptions, it's crucial to consider the ethical implications of our work. Ensuring that assumptions do not perpetuate biases or misrepresent individuals is essential. Transparency in methodology and findings fosters trust and credibility in research. Testing and validation. Validating behavioral assumptions through rigorous testing is a significant step in ensuring accuracy. Pilot studies, field experiments, and continuous feedback loops can refine these assumptions. Iterative testing. Adopting an iterative approach helps in continuously improving models and assumptions. Gathering real-time data allows for adjustments and enhancements, keeping the research relevant and accurate. Following up. Regular follow-ups with stakeholders can provide insights into the lasting impacts of behavioral assumptions on different populations. This can highlight trends over time and expose areas needing further research. Conclusion. Advanced techniques in behavioral assumptions are essential for creating a nuanced understanding of human behavior. By focusing on context, utilizing diverse data sources, incorporating complexity, fostering collaboration, considering ethics, and prioritizing validation, researchers can achieve a delicate balance between accuracy and realism in their work. Exploring these techniques not only benefits academic research but also informs practical applications in marketing, policymaking, and beyond. Governance and validation of behavioral assumptions, ensuring reliability. Understanding the role of governance and validation in the context of behavioral assumptions is crucial for organizations operating in various sectors. This script will delve into the importance of these processes and outline effective strategies to ensure reliability. The importance of governance. Governance refers to the framework of rules, practices, and processes through which an organization is directed and controlled. In the context of behavioral assumptions, governance is vital because it establishes authority, accountability, and regulations that guide how decisions are made. Organizations must develop governance structures that clearly define roles and responsibilities. This not only helps in compliance with regulations but also fosters a culture of transparency. When behavioral assumptions are governed effectively, organizations can better anticipate risks and devise strategies to mitigate them. Understanding behavioral assumptions. Behavioral assumptions are the often unconscious beliefs or expectations that guide decision-making. They play a significant role in how organizations interpret data and react to various situations. However, these assumptions can sometimes lead to biases, impacting the effectiveness of strategies. For instance, if a company assumes that a certain customer segment will always respond positively to a specific marketing tactic, it might overlook market changes or evolving consumer preferences. This highlights the need for continual validation of these assumptions. Importance of validation. Validation is the process of confirming that the behavioral assumptions hold true in real-world scenarios. This can be achieved through empirical testing, data analysis, and feedback mechanisms. By validating assumptions, organizations can ensure that their strategies remain aligned with actual behaviors and trends. The validation process can be broken down into several steps. Data collection. Organizations must gather relevant data that can be used to test behavioral assumptions. This can involve quantitative data, such as sales figures or website traffic, as well as qualitative data, like customer feedback and surveys. Testing assumptions. Once the data is collected, organizations should analyze it to test their behavioral assumptions. Statistical methods can be employed to determine if the assumptions are supported by the data. If the data contradicts the assumptions, it prompts a re-evaluation of the underlying beliefs guiding decision-making. Continuous monitoring. Behavioral assumptions should not only be validated periodically, but organizations must also engage in continuous monitoring. Markets and consumer behaviors evolve, and assumptions that were once valid may become obsolete. Regular check-ins help maintain the relevance of the assumptions in light of new trends. Strategies for effective governance and validation. To ensure effective governance and validation of behavioral assumptions, organizations can adopt several strategies. Establish clear protocols. Setting up clear policies and procedures around governance and validation is essential. This includes defining how assumptions will be documented, tested, and revised. Foster a culture of open communication. Encouraging open dialogue among teams will help surface different perspectives about behavioral assumptions. This diversity of thought can lead to more robust decision-making. Utilize technological tools. Leveraging data analytics tools can aid in the validation process. These tools can help organizations visualize data trends and assess the validity of their assumptions more efficiently. Engage stakeholders. Involve key stakeholders in the governance process. Their insights can provide a broader understanding of behavioral assumptions, enhancing the overall strategy. Document learnings. Finally, it's vital to document the findings from the validation process. These records not only serve as a reference for future assumptions, but also help create a knowledge repository for the organization. Conclusion. In summary, effective governance and validation of behavioral assumptions are fundamental for ensuring the reliability of organizational strategies. By employing a structured approach, organizations can make informed decisions that reflect actual behaviors and trends. In an ever-evolving market landscape, maintaining vigilance over behavioral assumptions will empower organizations to adapt and thrive.